Welcome. We're going to get started here. Welcome to the Vincent Hirsch Financial Services Financial Education Series. Today's topic, navigating student loans. My name is Christopher Hirsch. I'm a partner here at Vincent Hirsch Financial Services. For those of you that don't know me, I'm sitting next to George Saradakis, an associate with the firm. We are beginning a financial education series. Our relationships with our clients have always been rooted in education and communication. Over the past several years, we've begun speaking at universities as well as to business groups and their employees, providing financial education. And we felt that we would like to have another opportunity to reach out to our clients in a form such as these and provide that same type of education to more of our clients to get a broader reach. And that is how this financial series came to be, when we're very proud to be bringing it to you. Today, we'll be speaking about navigating student loans. We'll be going through slides, and at the end, there will be time to address your individual questions. So please pay attention. Jot down any questions that you have, and we'll make sure that we try to address any questions that you have at the end. George, take it away.
Sure. And if anyone has any questions in the interim, there is a Q&A feature that is included in the Zoom webinar. So we will be checking that periodically. If there's a question that we could address at that time, we will. But otherwise, we will save most of the questions for the end. My name is George Saradakis. I'm an associate here at Hirsch Financial. I've been here for probably the better part of between 4 and 5 years. And I'm very proud and thankful to Chris and the rest of the partners for allowing me the opportunity to co-host our first webinar. And we're going to get started. So today we're going to talk about navigating student loans. There's been a lot of change. There's been a lot of confusion over the past 12 to 18 months regarding student loans and the new legislation that has come since July of 2025. So we wanted to take some time to address the navigating of student loans under the new legislation. And what we're going to cover today are a handful of topics. We're going to first address the difference between federal and private loans, and then we're going to dive into the federal loans aspect of the categories, which begin with subsidized and unsubsidized student loans and the difference between those. We're going to talk about and address the Big Beautiful Bill Act, which was the legislation that was passed in July of 2025, and the implications that it has on student loans today and into the foreseeable future. We're going to talk about how the legislation has affected public service loan forgiveness, or PSLF, for those of us who are qualified to take advantage of that service. We're going to talk about Parent Plus loans for those of us who have Parent Plus loans, our eligibility for it, any qualifications that we have now and into the foreseeable future. And we're also going to talk about what we could do over the course of the next 12 to 18 months to really make sure that we are taking advantage of any opportunities that we have, and then also making sure that we don't miss anything between now and some key details and some key dates along the way. So first, we're going to address federal and private loans. The key difference here is that federal loans are issued and backed by the U.S. Department of Education, which means that the interest rates are fixed and set by Congress on an annual basis. Now, a key characteristic of federal loans is that they have access to income-driven repayment plans, which means that there are repayment options that are directly tied to our annual income. And they also allow for eligibility for forgiveness payments through these income-driven repayment options, and also through the public service loan forgiveness, which we're going to get to later in the presentation. It's not uncommon for no credit checks to be required for federal loans. They are based on need, and then they're also available to everybody upon completion of the FAFSA, which we're going to get into in the next couple of slides. And federal loans also offer the opportunity for grace periods upon graduating undergraduate programs, and they also allow for flexibility through deferment and forbearance options as well. And for those of us who may or may not have federal loans, common providers that we have are direct subsidized and unsubsidized. This would come by way of the federal government, grad plus loans, and parent plus loans. Some common providers of private loans are just those that are private banks, credit unions, and online lenders such as SoFi or Discover or any other private bank or credit union that's willing to extend student loans. These loans are usually tied to credit score. Therefore, the interest rates may vary based on your credit. Because of that, there's no access to federal forgiveness programs such as IDR programs or PSLF. Those loans are relatively straightforward, similar to like a car loan or a mortgage. And because of that, there's fewer borrower protections such as forbearance or deferment. And we want to check with the providers with regards to any terms and conditions that may be tied to these loans. Diving further into federal loans, we have what are called subsidized and unsubsidized loans. When it comes to subsidized loans, these tend to be more granted on a needs-based condition, whereby the completion of the FAFSA will demonstrate whether or not a student is eligible or displays need for these types of loans. And they're loans that are available typically on an undergraduate student loan basis.
Just if I could interrupt, George.
Sure.
For those of us out there, what is the FAFSA?
Sure. So the FAFSA the acronym is the Free Application for Federal Student Aid. And we are required to complete it upon going into each academic year, typically. And it essentially allows us to see how much federal aid or any kind of student aid that we're eligible for. And what happens is it collects information such as marital status, household status, how much income we have, level of assets and level of liabilities, so total net worth. And based on that, for the parents and for the students, we're extended a score. Now, when we look at that score, the score that's extended is, when we analyze the score, a lower score represents a higher need for student aid, which means that we're more likely to get approved for subsidized federal student aid or things like Pell Grant or more unsubsidized student loans. The higher of a score, which means that we have a lesser of a need demonstrated, we tend not to get approved for subsidized student loans. We may get less of a subsidized student loan. We may not be offered the opportunity for Pell Grant money, and we may get unsubsidized student loans, but it may be less than if we were to display a higher base need.
So if I'm understanding you correctly, to even begin this process, requesting or applying for student aid, we have to fill out the FAFSA, correct?
Yeah, that's correct.
And my understanding is the initial deadline for that FAFSA is, or the first time, the initial early deadline is June 30th. Is that correct?
Yeah, so each academic year has its own deadline. And for this year, the deadline, or for 26-27 school year will be June 30th.
Thanks.
So back to subsidized student loans. These are student loans where the government will pay interest while we're enrolled in school at least half time. And because of that, it's the nature of the subsidized student loans that the loans don't accrue interest during our enrollment in the school. And it even continues to push off the interest accrual until 6 months after we've graduated undergrad. And for reference, the 2024-2025 interest rate of these subsidized loans was about 6.5% or 6.53%. On the other side, unsubsidized student loans are available to everybody who fills out the FAFSA. It's available to undergraduate students, graduate students, and even professional students, such as those who are pursuing an MBA or a JD. These are not necessarily based on financial aid because they are available to everybody who completes the FAFSA. It's just how much we're eligible for. Unlike subsidized student loans, interest begins accruing from day zero. So if I take a unsubsidized student loan out on July 1 of 2026 and I graduate in 2030, from 2026 all the way through 2030, my interest on these loans begins to accrue and capitalizes. And we have similar opportunities for repayment programs for unsubsidized student loans as we do for subsidized student loans, because they are also federal loan programs.
So if I'm understanding you, the subsidized and unsubsidized are both federal loan programs.
Yeah, that's correct.
And everything we'll be talking about further along about repayment programs or et cetera would be eligible for either one of those.
They all fall under the jurisdiction of federal student loans.
Okay. And the big difference between these two kinds of loans is one, the interest does not accrue while you're being educated, while you're in school until 6 months after. And with the unsubsidized loans, they begin to accrue interest from the day you take that loan, correct?
Yeah, exactly.
Okay.
And then just to kind of wrap this up, the 2024-25 rates for reference were also 6.53% for undergrad and then 8% for graduate loans. So moving on to the big, beautiful bill that was passed in July of 2025, there were a few significant restructuring of the federal student loan system, to put it lightly, which the main and key points for these were the implementation and the introduction of a new repayment option, which is called the Repayment Assistance Plan, or the RAP, which is going to act as the primary income-driven repayment option moving forward. It was the elimination also of the SAVE plan, which was introduced under President Biden, which was eliminated as of March of 2026. We're also phasing out legacy IDRs that a lot of us may have enjoyed in the past couple of years prior to SAVE. And then we're also eliminating Grad Plus loans, which were federal student loans that were extended to those who are pursuing graduate degrees, such as maybe an MBA, maybe a PhD program or a master's, etc.
You used a term right there, IDR. Can you explain what that is real quick?
Sure. So an IDR stands for income-driven repayment plans. It's essentially a repayment plan option that is tied to our repayment plan program that's tied to our annual income. And common IDRs were the income-based repayment plan, the pay-as-you-earn plan, and the income contingent plan. And the primary difference between the three of these were actually how they were calculated based on our adjusted gross income, or AGI, and how it related to the federal poverty level. Gotcha. So first, we're going to address the elimination of Grad Plus loans. Grad Plus loans are eliminated effective July 1 of 2026. So because of that, they are closed to new borrowers as of that date. And borrowers who were not previously borrowed under Grad Plus loans will have no access to the program moving forward. However, those who did borrow under the Grad Plus program and had loans dispersed prior to July 1 of 2026 will be grandfathered in and will remain continuously enrolled within the program at the same school for an additional 3 academic years, or until the completion of your program, whichever occurs first. Something new that's included on this Grad Plus is the implementation of a lifetime borrowing cap of $257,500 and the impact on professional programs. So programs such as law, medical, dental, and MBA students who've historically enjoyed Grad Plus loans to cover the full cost of attendance will face the funding gaps because of this lifetime borrowing cap and because of an annual imposed cap of $20,500 per year for graduate programs, or $50,000 a year for professional. So because of that, they may have to take on private loans or private fund, self-fund rather, these programs, because they won't be able to fully fund it through the Grad Plus loan. With regards to the new implementation of the new repayment assistance plan, we have the RAP, which is essentially a payment it's a repayment plan, which the payment is calculated based upon a bracketed structure similar to a tax bracket system, as opposed to legacy IDRs or legacy income-driven repayment plans, which we alluded to earlier, where it also considered the federal poverty line. And unlike legacy IDRs, the repayment assistance plan has a 30-year timeline to forgiveness on qualifying payments, whether it's undergrad or graduate debt, and compared to legacy IDRs, which may have had a 10 to 25-year forgiveness, depending on the plan that we were enrolled. RAP also includes provision to prevent negative amortization. So if our monthly payments aren't enough to cover the monthly interest that's accrued, we won't be negatively penalized for any interest that may have amortized on the loan. There's also a consideration for spousal income. So when we work with our clients in a planning consideration, something new that we have to look at is whether or not that spousal income is going to affect how much we're going to be paying under the RAP now. And then finally, borrowers who are previously enrolled in the SAVE, the SAVE plan, will be administratively moved to RAP or ought to consider another qualifying plan due to the fact that SAVE has been eliminated as of March 1st. Because of the elimination of SAVE, it's worth noting what it is that SAVE offered just briefly. So SAVE capped payments at 5% of discretionary income for undergrad loans and 10% for graduate loans, and offered forgiveness on balances less than or equal to $12,000 for after 10 years. And there was also an interest subsidy which prevented balance growth on 0% interest. Or $0 payments, excuse me. Now, what happens to enrollees who were previously on the SAVE program, now that SAVE is eliminated, is that they have to be transitioned to RAP or an eligible legacy plan, which has a 90-day window starting on July 1 of 2026. And borrowers should confirm with their new plan assignment with their servicers, because different servicers may have different timelines as to when they want to get that process started. Regarding phase out of legacy IDR plans, the three main legacy IDR plans that are worth noting is the income-based repayment plan, which is being phased out as of July 1 of 2027. You have the pay-as-you-earn plan, the PAYE plan, which is closed to new enrollees. And then you have the income contingent repayment plan, or the ICR, which is set to sunset within the next couple of years. And each of these differ from the last based on the calculation, the forgiveness timeline, so 20 or 25 years, and the eligibility for whether or not it's going to be grandfathered under RAP or not. So a key timeline with regards to the big, beautiful bill is, it's a little confusing because there was a lot thrown at us in the legislation. So put simply, we're now in this 2026 time part of the timeline where the RAP is fully operational. Back in 2025, the OBBA was enacted, and there was a transition from 2025 to 2026 where enrollees within the SAVE program ought to have considered alternative repayment options due to the fact that it was eliminated, or it was set to be eliminated in March of 2026 at the time. Now that RAP is fully operational and set to take effect on July 1 of 2026, enrollees are able to transition into RAP effective that date. We're also looking at the wind down of legacy IDR plans over the course of the next 2 years from 2026 to 2027. And those borrowers ought to consider alternative repayment options as well, similar to those who were enrolled in SAVE. And then as of 2027, new Grad Plus framework is fully in effect, where we don't have any new borrowers who are able to take advantage of those plans. One question we get a lot as a team is the opportunity for public service loan forgiveness. And so for students, those who work in non-for-profit or any kind of state or government organization are able to take advantage of the PSLF, but they have to have direct loans and must be enrolled in a qualifying repayment plan, such as an IVR, standard repayment plan, or the new RAP. And they have to make 120 qualifying payments, which means that they have to be working for a qualified employer, such as a 501c3, government, or other non-for-profit, in order to have their loans forgiven income tax free. But those 120 payments don't have to be consecutive. It is worth noting that they should certify their employment qualification on an annual basis, because it does take some time to process any forgiveness when the time does come. When it comes to parents, these Parent Plus loans are not directly PSLF eligible. Therefore, parents ought to consider consolidating into a consolidation loan by June 30th of this year, so within the next couple of weeks. And they also have to make 120 qualifying payments under the same criteria, 501c3, government organization, or other qualifying nonprofit, in order to qualify and take advantage of the PSLF and have loans forgiven federal income tax free. When it comes to Parent Plus loans under the new legislation, there are limits and eligibility requirements that we have to consider. When it comes to limitations of the Parent Plus loans, they are now capped at $20,000 per year per student, with a $65,000 lifetime limit, and it also requires a credit check. When it comes to interest rates, there is an origination fee of about 4.25%, with a fixed rate of about 9% as of last year. There is a critical OBBBA deadline of June 30th, 2026, which means that as of then, we're not able to take out any consolidation loans that would help us qualify for the PSLF. And we're able to find and apply for these consolidation loans through FSA.gov, or studentaid.gov, excuse me. Now, it is worth noting that when it comes to Parent Plus loans, the parent, not the student, is legally responsible. And so if mom signs for her student's loan as a Parent Plus loan, then the parent is the one who's responsible and ultimately the one who's going to be paying the student loan, not the student. The Parent Plus loans are taken in the parents' names. So what can we do as we wrap this up? What can we do over the next couple of months to make sure that we're taking the right steps? And so the first is that we want to log on to studentaid.gov and make sure that we review our loan balances, who our servicer is, and the history of our payments. We want to make sure that the current repayment plan option that we find ourselves in is available post OBBBA. So whether that's ICR, standard, or the new RAP plan. And we also want to make sure that we contact our servicer with regards to transitioning if that's applicable to us. With regards to students or young professionals, we want to make sure if we do want to take advantage of PSLF, does our employer qualify for those payments? If, for instance, if I work for a school or if I work for a state legislator, those do apply. If I work in private practice, such as what I find myself in, unfortunately, I'm not able to take advantage of PSLF forgiveness. And if we want to pursue any kind of grad school, then we have to make sure that we take advantage of the Grad Plus grandfather program prior to June 30th, if that's something that we're even old enough to take advantage of. For parents, if we're looking to pursue PSLF under the Parent Plus loans, we want to make sure that we consolidate, enroll, and make at least one ICR payment prior to June 30th. It's more important that we consolidate and enroll prior to June 30th. And we want to make sure that we don't take out any Parent Plus loans after July 1 of 2026 if we are looking to take advantage of PSLF, because it permanently strips the eligibility to do so. So with all of that being said, we want to make sure that we're keeping these key deadlines in mind. Reach out to a financial professional or someone who is qualified to speak on student loans, and don't ignore servicer communications. There's been a lot of communications from Mohila or Nelnet or whomever our servicer is via email, and sometimes it just ends up in junk. So make sure that we're keeping on top of that stuff. And with all of that, I want to thank you all so much for your time. I know that sometimes the middle of the day for these kinds of things is a bit hard. So we want to thank you guys the time for giving us the opportunity to help educate on this topic.
Now, you have up there different places that our clients or anyone watching can go and find out more information, whether or not they're in the current repayment phase or just someone who is looking or just about to begin school and will be dealing with student loans. I also want everyone to know that we will be taping or recording this session and putting it up on our website. If you'd like to go back over it, review it, or refer someone else to access it and have a benefit from there. And we're going to take a few questions right now, if anyone has any. But I also want anyone to know that you could also give our office a call or go online and schedule an appointment with us if you have any questions regarding anything that was discussed today. So, George, if you want to look and see if anyone has any questions, please let us know and we can open it up.
Yeah, I don't see any questions in the box right now, but like Chris mentioned, if anyone does have any questions, please feel free to contact our office. We're more than happy to schedule some time to kind of chat about your specific personal situation more in depthly.
The best way to contact our office, George?
So you can reach out to me, which would be George.Saradakis, which is PSARADAKIS @prudential.com. You can also go onto our website and submit just a ticket to see how we can best help you. Or you can also contact our office at 732-335-8861.
Great. Thank you very much, George.
Of course. Thank
I
you,
hope
guys.
everyone found this very informative. I know I did. And we'll see you with our next session coming soon.
Thank you, guys.